Welcome everybody. I'm your instructor. This is a class that Riche asked me to put together. I'm very happy to be here doing it. I actually have taught in the past. I used to teach for USC's healthcare graduate program when I was in Sacramento.
Right on, USC? Or
Right
UC?
on. USC. USC, not UC, USC. I'm qualified to teach this class. I've been a CFO for about 30 years. I started in healthcare in 1982. I went through college in Los Angeles, got a degree in accounting, and served in the Air Force for 6 years. Then I went into healthcare and started at Sutter and became their CFO. And I was Sutter's CFO for about 10 years when they were growing and putting the system together. And then I've been CFOs at other places. I've been here about 2 years, so we're really looking forward to it. Normally, when I'm presenting, I'm like presenting to a board, and I'm trying to convey, a bunch of information in a short period of time, sometimes in a hostile environment. But this is not like that. This is about you. This is educational. So my intent here is simply to find out from you what you need to know. I've kind of designed this course in a way that I think will be helpful for you to get you through it. We're going to start at a high level, but we can modify it. In fact, I taught the first class 2 days ago, and I actually made some modifications to the course. I took a few things out. I added some other things to make it better, so it'd be more understandable. Okay? So essentially what I'm trying to do is teach you financial concepts that you can use in your daily work environment. Certainly, if you ever get into things like budget negotiations or, maybe you're doing a programmatic review, maybe there's a new service that we want to start, who knows. It's going to be very helpful for you to understand these concepts, the language we use, how somebody like myself looks at various opportunities. So that's there. We're going to talk a little about budgets, target setting, resource allocation. Okay, what does resource allocation mean? Anybody have a clue with that? Basically, as we'll talk about, we get into the financial statements, so we have an expense budget. So the expense budget represents resource allocation. So we say, okay, we're going to have, 4,000 employees. Where they're going to be, which department gets those. We have a capital budget. So we're going to be spending about $30 million next year. We're actually going to finish with that. A little test on where do you think we should spend $30 million next year. Okay? So that's resource allocation. That's a big issue. And then eventually in the course we're going to get to how we evaluate projects, how we do performance improvement. And you can see we've got 5 lessons here. And so the first one is kind of a very high level. So I thought I'd start really high level because if you get far enough up, you can kind of see the big picture. And then subsequent lessons will be sort of drilling down into some of the individual components so we can kind of refine that. But we're going to start with the big picture. So first one is long-term financial planning. And so my objectives today is I want to give you just a very brief look at financial statements. So when we talk about financial statements and income statement and balance sheet, you kind of know what I'm talking about and why, how they're used. In the second lesson, we're going to come back and go into more detail. I'm going to teach you how to read a set of financial statements. But we're going to start at a very high level, just the big, broad concepts of what they do. Because that's important because we're going to be talking about a lot of financial terms, as you can imagine. Then we're going to talk about the long-term financial planning process. Now that's really timely because we're actually in the process of setting our budget with the board right now, and a lot of this ties directly to the budgeting process. We're going to talk about this concept called free cash flow, and then but basically free cash flow is the amount of money that we generate after operations, after we pay your salaries and all the vendors, the amount of money we have left to invest in capital or pay down long-term debt or start a new program or do something like that. So my objective today is just really to teach you where the money comes from, where it goes, and the kinds of decisions we have to make. Okay? All right, and you can interrupt me anytime. This can be very, very conversational. It's meant to be conversational. Yeah.
Would it be okay, maybe for us as nurses, things that are important will be things like direct care,
Mm-hmm.
indirect care, ADC,
Mm-hmm.
number of hours,
Yes.
patient care day.
Yeah.
Those are the things that we as nurses
Yes.
will be really face day to day.
Yes.
Would it be possible to add that?
Yeah, and we're actually, when we get down to session 4, which is operational analysis, that's when I'm going to get into some of that detail. I'm going to talk about performance improvement, how you go about turning an organization around, the kinds of things you put in place, things like that. But today we're going to start at a high level. Okay, so I always like to start this with something funny. So here's a quote: "Happiness is positive cash flow." Okay. Although actually it's not that funny, because when I first arrived here 2 years ago, we did not have positive cash flow. In fact, we were in a deficit. And that was a very, very tenuous, stressful situation. And what generally happens without adequate cash flow to pay our bills is some people don't get paid. And they wind up being pretty unhappy, and they get on the phone to call me, and they call supervisors and other things and board of directors, and everybody comes to me and says, well, you know, how come I can't get paid? So that's why it's important for you to understand about where the cash comes from and where it goes and how we balance that, how we plan for it. Okay, and I'm going to keep talking about cash because cash is really important. And one of the things you'll see is in terms of running an organization, the number one reason any organization goes out of business is they run out of cash, okay, for one reason or another. Okay. Well, what do we do with cash? So, you know, we get cash because we take care of patients, we send out bills, we get paid. If we do everything right, we get paid. Plus, we get a bunch of supplemental reimbursement from government programs. And that totals about, what do you think, how much revenue do you think we bring in a year right now? Any guesses? Just order of magnitude. What do you think our annual revenue or annual cash flow, annual expenses are? 250 million. Okay, $900 million. 900. Next year it's going to be about 920. So very shortly we're going to be a, quote, billion-dollar organization, which is a pretty big deal. It's a lot of money. And you're going to get to see where that, you know, where that comes from. But then when we operate a hospital, in order to take care of patients and bring that money in, we have to have employees. We have to have all of you taking care of patients, and we have to pay you. How often do you get paid? Every other week. You get paid every 2 weeks, right? Okay. We have other needs. So we have something called working capital, which we're going to talk about. But basically, there's a timing lag between when we have to pay you for your services and when we collect. So how long do you think it takes us to get a bill out and bring the money back in? It's about 60 to 70 days right now, okay? So if we're paying you every 2 weeks, but I don't get paid from the payers for 2 months, where do you think that money comes from? That's called working capital. So that's money that we have to have just to operate the hospital before we have profits or anything. Then we have something called debt service, which is we owe people money, we have to pay that back. And then finally, we have to do, or we'd like to do, capital expenditures, facilities, equipment, IT, strategic projects. And what happens when we run short of cash is we have to prioritize, okay, who gets paid and what we do. So what do you think the highest priority is? Employees, yes, because if we don't pay our employees, they're unhappy. But more importantly, to me, it's actually illegal for me to let you work and not be able to pay you. I could go to jail, okay? Seriously. And if you don't pay your payroll taxes to the government, they get really upset, okay? So that's the highest priority. But then there, at the bottom of the list, there are things that are what are called discretionary, okay, like equipment, okay. Now, some equipment we have to get because it breaks and it's required for patient care, but some just, new beds, kind of discretionary. We'd like to have new beds. We can live with a 20-year-old bed. We'd like to have new ones, but if you don't have the money, you can't do it. And so what's happened here over the last, 10 years or so is that very, very little capital equipment was purchased. And so what does that look like from your perspective? The floors are dirty, walls need painting, beds get old, equipment breaks, all that stuff, okay? So one of my jobs is to make sure that we have enough cash to keep everything current, okay? All right. All right, now we're going to talk about financial statements. And in your package, I'm just going to give you this for reference. All the way at the back, the last tab, there's a little memo from me to the Finance Committee. And behind that are our actual financial statements. We'll be referencing those. I just want to point them out to you at this point. And there's basically in finance, there's 3 reports that we use. We call them statements, but they're financial reports that we use to understand everything that we need to about a company. And this is not unique to hospitals. Any business in the world uses these 3 financial statements, okay? And they work together. So the first one's called an income statement or a statement of revenues and expenses. It means the same thing. But basically what an income statement does is it measures our performance. It measures how much revenue we generate. That's that 900 million number. What our expenses are, so how much money we have to spend to generate that revenue, and then whether we have a surplus or not. And that surplus is called income. Okay, so revenues minus expenses equals income, all right? Then there's a balance sheet. Yeah.
Hold on a second.
Mhm, yeah.
Revenues minus expenses equals, is that here or am I overlooking?
It's actually right there.
Okay.
It's right there. It's
Gotcha.
coming up at you. Okay. The next one is called a balance sheet. Okay, and the reason it balances is you have something called assets, which are things like this desk or this building or all the equipment that you work with or this, facility. Those are assets. Cash is an asset. Receivables are an asset. So that's on the left side, and assets equals what's called liabilities and equity. So liabilities are money that we owe to people, other organizations, and equity is the difference, okay? And in a future lesson, we're going to talk about the ratios of those because it really talks about how an organization is capitalized. Capitalized means where do you get the money to set up a business and run it, okay? But the important thing about a balance sheet is it measures not our performance but our health, okay? So at any point in time, it's that you can look at a balance sheet, figure out how much cash you have, figure out what your liquidity ratios are, capitalization ratios, figure out your debt. Lots of things we're going to learn about. So income statement is performance, and performance is measured over a period of time, typically a month or a year, whereas a balance sheet is reported as of a specific moment in time, not a period, but a specific moment in time. And then what a statement of cash flow does is explains why cash goes up or down. Okay, that's high level. Now let's go through that. Yeah.
In your balance sheet, for instance,
Yeah.
do you have to have a certain amount of cash flow, meaning that, for instance, for 30 days or 60 days?
You should. We are kind of unique, and we're going to actually talk about that today because we're in a unique situation where we are financed or capitalized by the county through a loan. And the loan has certain parameters that we have to meet. But that gives us the ability to borrow money from them to fund operations. What was I going to say? But along with that, they have a provision. So there's this golden rule of finance, and the golden rule of finance is, he who has the gold makes the rules. Okay, so right now, The county has the money, they make the rules. They say, we're going to lend you money, but here are the rules, okay? And one of the rules is that everything that all the money that comes into us doesn't come into us. It comes to the county, to their bank account. And we track it. It's ours, but it's over there. And then if we want money for payroll or to pay vendors, I have to ask for it. And I do that every week. Okay? Okay. Yeah. Okay, so very quickly, so here's an income statement. If you look at the top of an income statement, it should say for the period ending, which ours does. The formula is revenues minus expenses equal income, okay? And if you looked at our income statement, which is that first report, you'll see lots and lots of numbers, but the top part is revenue, the middle part is expenses, and the bottom is income, okay? And it's about, if we were to annualize it, that's for 9 months, so it's not a full year. If you would annualize that, it's about $900 million of revenue, 870 of expenses, and 30 million of profit or income. Okay? All right. Here's the formula for the balance sheet. Assets equal liabilities plus equity. That's the second report back there. And again, bunches of numbers, but on the top part, it lists all of our assets, and they total about 400 million. It lists all of our liabilities, and that totals actually 700 million. And then the difference, which is our net worth or equity, is minus $300 million. Okay? Now, generally you want equity to be positive. We're negative. So we're like digging out of this hole, and you'd say, well, gee, if the organization's worth a negative $300 million, how on earth are you staying in business? The answer is because we have cash. We can do that, and we have prospects, and we're improving and things like that. And there's some special things related to pensions that we'll get into at a later date maybe that sort of confuse the issue. But that's the basic message.
One thing one question.
Yeah.
I just didn't see the net pay that, like how much money that, we pay, or how much money we receive in terms of net income.
So that is on the income statement, if you want to look at it. And first of all, just go back to what I wrote, to that first page that I wrote. And I'm looking, this is behind the first tab, meet of the Finance Committee. We're reporting operating income of $6.6 million for the month of March and $17 million year to date for 9 months, okay? And then,
I don't have my glasses with me.
oh, okay, all right, well let's not get too much into that today because we're going to do that next time, okay? I didn't want to overwhelm you with numbers. I just want to give you the concepts. So there's an income statement, there's a balance sheet, and then there's a statement of cash flow. So an income statement measures what? Performance, okay? So how fast can we run the 100-yard dash, okay? A balance sheet measures health. What's your blood pressure, okay? Difference, okay? And then finally, because those two statements are done under what's called the accrual accounting or generally accepted accounting principles, which means it's not exactly the same as cash. We want to have a separate report because cash is really important. So we want to understand what's going on with cash. And that's what the third one does. And basically we group cash into 3 types of things. One is how much cash we generate from operations. The second is how much we spend on capital. And the third is how much we spend or borrow on debt. Okay? So those 3 documents give you everything you really need to know about a company. And I've been doing this a long time. I can pull up a set of statements, I can read it like a book and know exactly what's going on. And you will too by the time we finish this. No,
it's pretty
probably not.
standard to have negative numbers in the parentheses or brackets, right?
Yeah, well, particularly when you put them together, you want to know that one is plus, like we generated $45 million in cash from operations. We spent $30 million on buying things, or we spent $15 million on reducing debt. So just to avoid confusion. But sometimes we move sometimes we move the pluses and minuses because I understand what they are, but it confuses everybody else. So we had an incident yesterday where we got this report from the state on something called the AB 85 redirection money, and it was a minus $16 million. So, you know, my boss comes running and says, "Oh my God, we're going to lose $16 million." I look at, no. It means they're reducing the amount that they're going to withhold from the county when the money. So by the time it gets to us, it's 16 million more. It's good news. So it's easy to make mistakes. Okay. All right. So now let's talk about some terms. All right. So first one is something called EBITDA, free cash flow. And what we're doing there is we are essentially looking at the income statement, that first statement, which is revenues minus expenses equals income, and adjusting it by taking out expenses that aren't really cash. And so in accounting, I mentioned this, generally accepted accounting principles, we have something called depreciation. Okay, so if we buy, as we have just done, all new beds for Alameda Hospital, that's $2 million or something, okay? That's not an expense. That doesn't hit the income statement. And the reason is those beds are going to be used for more than just 1 year. They're going to be used for maybe 10 years. So what we'll do is we'll say, okay, well, that's $2 million. It's going to be used for 10 years. We'll put the $2 million on the balance sheet as an asset, and then we will depreciate it. We will allocate that expense, $200,000 a year, to the income statement. And that's the intent is to give us on the income statement a real assessment of how we're actually doing. Because if you just put all the cash on there and said, oh, well, we built a $100 million building this year, so did we lose $100 million? No, we just made an investment. So investments are capital assets. They go on the balance sheet, and then those assets get expensed over time through depreciation. Okay? So what we're doing is we're converting income into cash, free cash flow. Now, those two numbers are, in our case, pretty close, actually, because we don't have that much depreciation, because most of it's borne by the county. Yeah.
Is the depreciation value the same across the board for capital equipment, buildings?
Yeah, it depends on the category. So something like an IT system, there's guidelines, would be probably depreciated over 7 years. You know, some furniture might be 5 years. A building might be 30 years. Okay.
Which means at the end of 30 years it's worth nothing, or just worth
It means on the balance sheet the book value would be 0. You might still have it. The value is probably not 0, but from an accounting standpoint, the book value would be 0.
So would
Okay.
that get into, on the capital equipment form, I assume there's some type of length of life or whatever, does that get calculated into the depreciation of that?
Yes,
particular piece of
it
equipment?
does,
That's why
yeah.
you need
Yeah,
to
when
know
we
the
do that, it goes into something called a fixed asset ledger, where it says, okay, we bought this, here's how much we paid for it, here's the useful life, and then divides it out, and then that amount goes onto the, as an operating expenses depreciation.
And then one more, the T not being in there, is that because we're the taxation?
Yes, we do
Taxes
not
and
pay
some-
taxes, so some people do put that. So it's earnings before interest, depreciation, and amortization. Amortization is just like depreciation, except instead of a real asset, it's an intangible asset. Like if we had a copyright to some music or, who knows, goodwill that we purchased. Okay, all right. Working capital we talked about. Does everybody get working capital? You get the concept of working capital? So in our case, and the formula for working capital is current assets minus current liabilities. And if we went to the balance sheet, which you don't have to, but you could, and find the term current assets and looked up the value of that. In fact, let's just do it for fun. So this would be that second report after my letter. And it says balance sheet at the top. And if you go to that first subtotal, okay, so I'm on this report, it says balance sheet at the top, and assets, and then there's a listing of things, and then there's a subtotal right there. Okay? Does anybody see that? What's the number?
Doesn't have a number.
Next page.
Guess it'd be
Next.
9.
Nope, next page.
Yeah, I see the page, but there's no page number.
Oh, yeah, there's no page number, but it says balance sheet on top. Anyway, I'll just do it for you. It's okay.
Right at the back.
I could probably put page numbers on this, it'd be easier. It says 226185. Now, in finance, we typically drop 3 zeros just to save, ink. So 226 million is our current assets. And then if you go further down, there's a line for current liabilities, 122 million. Okay? So we have 226 million of current assets. In this case, mostly things that we've billed for but have not received yet, been paid for, and those are called receivables. Okay, so that's that timing difference. And then we only have 122 of liabilities, so we're more current paying our vendors and you than we are getting paid. That difference is about $100 million, okay? Which means we need $100 million of ready money just to keep this place afloat and pay the bills, okay? That's what working capital is. And I'll show you, I have a little graph on that in a little bit here. Okay. We're going to cover these terms again. So capital expenditure is something that we buy that is not an expense. Okay, so if I pay your salaries, and I do because if you look at your paycheck, it's actually got my name on it. Okay? That's not a capital asset, that's an expense, okay? But if I pay a vendor, individual, to develop an IT system that's going to benefit the organization for 5 years, that's a capital expense. Doesn't hit the income statement right away, except for the annual depreciation or amortization, but it's capital. So one expense goes to the income statement, the other payment goes to the balance sheet, okay? So that's important because it's important to get things on the balance sheet, which shows what we own, versus the income statement, which shows performance. So if I were to take that same $1 million or whatever it is and put it on the income statement, then our expenses would go up and our income would go down, and we would report less earnings. Okay, similarly for debt reduction, debt is a liability. Does anybody remember what financial statement liabilities show up on? So the income statement is revenues and expenses and income, and the balance sheet is assets and liabilities and equity. So it's on the balance sheet. So if I pay down debt, if I take cash, pay down debt, I'm reducing cash on the cash is an asset. I'm reducing cash on the balance sheet. I'm also reducing liabilities on the balance sheet, okay? But I'm not affecting the income statement, okay? This is important because the board typically pays attention to the income statement. So if I'm doing something that is distorting the income statement, making it look worse, they're going to get bad information, and they're going to use that information to make probably bad decisions like, oh my gosh, we better do a layoff because we have to cut expenses. Okay, so it's important to get these things, it actually has real implications. Okay, so now I want to talk about the relationship between revenue and performance and free cash flow. Okay, remember that concept, free cash flow? And so, again, free cash flow is the amount of money that we have left after we pay all of our normal expenses that we can then do something with, like pay down debt or invest in capital, okay? So, here's a question. Is it better to have more free cash flow or less free cash flow? More, because you can do more things, right? If you're going on a shopping spree, would you rather have $100 or $1,000? Probably 1,000. Okay. Okay. So right now, this year, actually, our net revenues are actually about $875,000 right now. So if you look down the left side, it's 875. That, and our performance is right about 4% right now, 4% EBITDA margin. So that's the amount of free cash flow divided by net revenue. So if we have 875 million of revenue and a 4% EBITDA margin, how much cash, how much free cash flow do we generate? $35 million. That's just intersected. Okay. Now, next year, our plan is to generate 900 million of net revenue, so increase more revenue, but to improve the performance to 5%. So if that were to happen, how much free cash flow would we generate? $45 million. Okay, very good. Okay, and that would then determine how much we have to spend on things we want to do. And so financial planning is really about balancing the amount of cash we generate with how much we can spend. Okay? Got it? Okay, good. All right. And that's kind of what I'm trying to talk about here is the way the capital, it's kind of hot, huh? I'm sweating. The way the capital planning process and strategic and financial planning process works. And typically what's supposed to happen is the strategic plan is developed for us around September, October, and it's a long-term plan, like 3 to 5 years. And then we do a financial plan around the end of the calendar year, maybe January, and we're going to show you what that actually looks like in a second. And at that point, the board looks at that discussion we just had and said, gee, you know, we think you need to have a 5% EBITDA margin because we have all these things that we want to do. And so they'd say, here's your operating target, and here's how much money you can spend on capital. Then, after that, around March, April, right about now, we then do a budgeting process. And we say, okay, can we take those targets and turn them into real allocations and start the year, which in our case is July 1st, with a budget. What is a budget, by the way? Does anybody know what a budget is? What is a budget? It's a plan. Okay. What does a budget mean to a department manager? Pain. 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 It's very hard. Creativity. It
means labor costs, staffing, direct care, indirect care, overtime, sick time,
Yeah.
equipment.
It's giving you the authority to run your business,
Yes.
right? So it's your authority. Okay. So your authority is determined by your budget. And as a manager, you can typically sign off on anything that's within yours. Can you sign off on something for another department? No, you can't. Can you spend more than your budget? You can.
Be responsible.
You can.
But you have to explain yourself.
You can, yeah. So that's your authority. Where do I get my authority? What is my authority?
Your authority is to make sure we get paid.
Yeah, that's my responsibility.
Sign all taxes.
Yeah.
Board and the
Yeah. Actually, not the county. So the board of directors has the authority to tell people how much they can spend. So if we do a budget that says we're going to spend 900 million, that's our authority. Now, I personally, myself, individually, can sign for anything up to $500,000. And my boss can sign up to $1 million, and above that, it has to go to the board, if it's a capital item. If it's within the budget, I can sign anything. That's authorizing expenditure. In terms of signing contracts, and the reason I'm going through this is in a later lesson, we're going to talk about how you do a turnaround. Okay, one of the things we did is we centralized the authority to bind the organization by signing a contract. So when I arrived, basically any manager could bind this organization by signing anything, and did. Okay, we had some good ones. So one of the first things we did is said, okay, there's only 2 people who can sign a contract in this organization. I'm one, my boss is the other. The board can't even do it. Okay, so that means everything has to come through one place. There's, that which allows us to evaluate it and make sure that everybody knows. We had departments doing similar projects, They didn't know each other were doing it, and just duplicating costs. Okay, so that's the cycle. The reason I'm showing you that is just so that bring you around to the financial planning process, which is what we're talking about today. Okay, so we're doing it. We actually did do it in January when we were supposed to. Now we're doing the budget, and I'm going to show you what we kind of went through and how that fits. Okay. Okay, now financial plan. This is actually a financial plan. This whole thing is right here. You can get much more detail than this, but this has got all the components. So the way this works is we start with where we are. I'm an old navigator, and one of the things you do is you figure out where you are, and then you know how to get to where you're going. So in 2016 is where we are. So our revenue this year will be about $875 million. And when we did this, we were, back in January, we were targeting about a 3% EBITDA margin. We're currently at 4%, but we had 3% at the time. And that would have generated about $26 million in free cash flow, okay, which is on line 3 and then carried to line 4. And then we improved our working capital by $20 million, okay. Any ideas how we did that? Okay, we collected our receivables. All those receivables are sitting out there, we collected them. So rather than sitting in somebody else's bank account, that cash was sitting in our bank account, okay? That was good. Debt service payments, about $18 million, and then at the very bottom, $25 million in capital. So that's kind of the plan for this year. And then that leaves us about a $6 million surplus. That's the plan. Okay. Well, what's the plan for next year? So this is what we told the board back in January. This is okay. Well, we think we can get the revenues up to $901 million. Okay, but we need to improve performance. Now the other group said, well, how are you going to improve performance? I said, well, we'll talk about that at a later lesson. But basically. Well, let me take it back. So which financial statement tells us our performance? Which? Correct. Income statement. Okay. So performance is income, and the formula to get to income is revenues minus expenses. So if we want to increase revenue or income, what are our choices? You got it. Excellent. You get an A. Okay, either increase revenue or decrease expenses. Okay, all right. So we said we think we can get revenues up to $900 million, and we think we can improve performance too. So that means that revenue is growing quicker than expenses. Okay. So 5% margin that would generate $45 million. Okay. We think there's still going to be a small improvement in working capital. Pay some debt. But then it means we can afford to spend $30 million on capital next year. $30 million, okay. Do you think that's enough? Yeah, I know. But this is a big deal. This is an important thing because, there's a lot of things that need to be done around here, right? Okay, and then we kind of project out in the future. But so does everybody kind of get the concept of a financial plan? So what we're doing is balancing cash we generate with cash we spend. All right? Okay. Now, remember I talked about that line of credit with the county? Okay. That's up here. That's that red line. And the blue line is working capital. So what I've done here is I've gone back to the balance sheets, and I said if I took current assets and subtracted current liabilities every year, what does that look like? And that's that blue line. And it's eerily close to the amount of money that we had to borrow from the county. Go figure. That's the $100 million. Okay. So it was kind of interesting because when I came here a couple years ago, which is that spike, that big red spike at the end of 2014, the county was going crazy, okay, because one of the things was I talked about rules. They had a rule that we couldn't go over a certain amount, and we went over that amount. And in particular, they said you have to be at a certain amount at June 30th of that year. And I started right after that, a couple weeks later, and they were over. Okay.
Well, is there a rule where the county can increase your line of credit?
They can. They have to go to the Board of Supervisors, and they were not happy. They were really seriously not happy. Okay? I mean, seriously. So the other group asked, well, what happens if you go over? And I said, bad things. Bad things happen. Okay? So the agreement says, number one, if you think you're going to go over, you need to tell them in advance and sit down and talk to them and work out a plan to avoid it. Okay? And then it says, if they're not happy, they can stop giving you money, which means we would go out of business. We would shut down. Okay? So what typically would happen is they'd come in and say, well, we don't like the way you're operating, so we're going to recommend some changes, and you're either going to do them or we're going to cut you off. And the changes could be replace the board, replace the management team, lay off staff, and basically whatever they wanted. So it's serious. So that was a serious event. But I was able to show them, like, well, gee, folks, let's look at the working capital. And the reason that, go back to 2010, it was $80 million, okay? And then all of a sudden, working capital is now 160 million, it's double. How did working capital double? What happened back then? What happened in 2011? New computer system. New computer system. Okay? Lousy implementation. Accounts receivable doubled because they couldn't get the bills out and get them collected. Almost took the organization down. Wow. Yeah. Wow. Yeah, it was an OMG moment. It was yeah. Okay. Since then, we've got it down quite a bit. We've actually got the days down to 69 days, and I'll show you the. So this is more granular. So we're taking on the right side there the actual agreement for this year, the year we're in. So you can see there's months on the bottom there. And the green line, basically what this says is, during the year, you can have you can borrow a certain amount of money, but by June 30th, that drops. And at that date, it has to be, in this case, $145 million at June 30th. July 1st, you can borrow back up again. But they want to see that steady drop, and that's that left column, that net negative balance limit at June 30th. And then on the right, the second column is the intra-year called flexible maximum, okay? So at June 30th of this year, yes?
I was going to ask you, does it go by fiscal year or?
It goes by fiscal year, and our fiscal year is June 30th. Yeah. So what we're doing here on the right is I'm projecting what that amount is going to be. In this case, that little arrow is when we did the projection. And you can see there's two lines. The reason is I'm kind of a high and a low, best case. So, but we're projecting to come in at about 110. Limit is 145. That makes me happy. That makes the county auditor very happy. I got a nice note from him last week. They're very happy people. It's nice. Pay our bills. And we have a cushion. So, okay. So that's capital. Now, we're almost to the end. Now, remember how I kept talking about financial planning be all about generating cash to spend it on things, right? Okay. Here's the wish list. This is what people want to do. Okay? And you can see after that, got that big top part, and I've got a total. And for 2017, we've got $31 million, just over the target of 30. But okay? But there's some big things on there. And that first column where it says total, that's adding up everything to the right. So, for example, if you look at number 12, JGPH expansion, John George Psychiatric Hospital expansion, that is a $30 million project. $1 million next year. You got to do architectural stuff. Okay.
To the ER, level 2 trauma, ETA, 4 minutes. Trauma team to the ER, level 2 plumber, EPA 4 fitters.
Okay. But in 2017, 31 million, but then look at 18, 19, and 20. 40 million, 50 million, 59 million. And there's still some things on the bottom that we haven't figured out how to pay for yet. Right? So, Okay, so now this is where financial planning comes in. Okay, how are we going to do that? Well, the plan says we're going to keep growing revenue and we're going to keep improving our EBITDA margin. That's the plan. We'll come back in a future course and talk about, well, how are we actually going to do that? You know, how do you make that happen? This is a nice plan, but how do you turn that into reality? Okay? All right, let's just stop there because we're actually at the end of the lesson. We're going to do a little test. Huh?
How are you going to increase margin?
One thing we're going to do is we're going to grow revenue. In fact, we're doing the budget. The target here was 901,250. We're currently at 920. So we're doing better on revenue. Okay. The other thing is we're going to control expense growth. I've got a graph I shared last night that showed sort of the boom and bust cycle. But with this organization, if you go back 10 years, there are years where they, kept their expense growth to 3% a year and started making money, and then they maybe got some extra money in like the district funds or something, and then all of a sudden the cost grows is 10 to 15% a year, just like they just had a party, and then of course 2-3 years later they're losing all this money. They say, oh my God, we've got to get this under control. So they either reduce costs or just they get the costs back down. Then a couple years later they're making money, and then they go through the same cycle. And the county is very, very cognizant of this. I mean, Devecki and I met with the county 2 weeks ago, and they're like, guys, this is really good, but we've been here a lot longer than you, and this is what we expect to happen, and don't let it. So we're targeting about a 3% cost growth next year. That's how we're going to. So keep getting revenue a little bit better than expenses. Get rid of consultants, labor optimization, all these things. We'll talk about that at a later meeting. Okay. So, comments. We don't need to go through that for information. Questions? Any questions at this point? Test? Do a test? Okay. We can do this together. Okay. What are the 3 financial statements? And they're quick.
Statement of cash flow.
Okay. What's the purpose of an income statement? Right. How about a balance sheet? What about cash flow? Track the money. Follow the money. Follow the money. Okay? Show me the money, whatever. Just to explain cash. Yeah, it's just. Okay, what is the difference between income and EBITDA? It's the E in EBITDA is actually the same as an I. They just change it because you'd have 2 I's. It's interest, depreciation, amortization. Essentially the non-cash items. Okay, to a CFO, happiness is. Okay, all right, love it. We actually answered number 7 already. What is the purpose of a financial plan? Balance, planning for cash. You want to make sure. I need to plan 3 to 5 years in advance that we can have the money to do the things we want to do. Last one. What is the highest priority capital project for next year?
In dollar?
No. Which one? If we could only do one of these, which ones would you do?
Expansion?
Oh, you said that grow revenue.
No, joint expansion?
We want to grow revenue, right?
I don't know. What would you do?
Expenses.
What would you do, Pat?
We need so much of our
Yeah.
I think it's
Yeah.
the,
Phoebe?
seismic.
Let's just take a vote. Phoebe, what did you do? Computer system, Mary Pat?
Probably seismic.
Seismic, okay. What would you do?
I like the Saurian rebuild.
Okay. Christine?
Same, either Saurian rebuild
Okay. Teresa?
Same.
Same? Heather?
I think it would be either the Sorian, fund or the just capital or,
Okay. Lori?
I'm anti-Sorian, so I'll say new.
Okay. Violetta?
Bringing our facilities.
Facilities? Okay. Okay. Cheryl?
Same thing, Sorian.
Okay. You want-
Computer system.
Okay.
I'd say the John George experience.
John George? Yeah. Okay. John George and John George. Okay.
Seismic readiness.
Okay. All right. There's no there's
Have a meter replacement, I mean, this
there's
light's
okay.
zero there.
There is no right answer to that question. It depends on your point of view. I'm
Want our hands in the cookie jar.
yeah. So I'm trying to generate as much cash as we can to get and then stage them so that we can get them done. Okay. And in addition to cash we generate, the other thing I'm trying to do is develop what's called an OPM strategy, which is other people's money. Which is go to one of our partners in the community and say, please give us money. So, for example, with the John George project, which is $30 million, we think we have a partner who might come in and help us.
We should ask Mark Zuckerberg, he just helped San Francisco General. so he would be
Exactly.
willing to give us some money.
Yeah.
Because his wife works
Or
in
Elon
San
Musk.
Francisco.
Okay.
Teach one county.
Just a couple minutes. So, how did this go? Did it meet your needs? Or-
That's great. Thank
yeah.
you.
Yeah.
I'm just wondering if some of your future classes, are you gonna kind of tie in the patient quality scores compared to our revenue and how CMS is going to be affecting?
Yeah. Yeah. Absolutely. Yeah. No, we can do that. Yeah. Sure. Absolutely.
So you talk about this future of what we're gonna get to, I think what was it like when you first started, so we can sort of have a comparison? Because I know you did a lot of work, so
Yeah.
it's hard to look to say we're gonna get to 5 or 6%, but I think you brought it up from like 1 to 3, right?
It was at the time -3.
Oh,
-3. So we were just sucking cash. We were in bad shape.
So 7% over 2 years, right?
Yeah. 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 Yeah.
And that one's by.
From one time. Yeah. No, we were.
Yeah.
I mean, they were facing. It was dire straits. I mean, it was. There were nights when I didn't sleep because I wasn't sure I could make payroll in July and August.
Way to bring that kind of stuff to the staff, just to kind of show them this is why patient satisfaction, this is why these things are important, because they
Yeah.
don't hear a lot of this stuff. They just hear it from us. They think we're just dumb.
Yeah, I mean, I think we could, but I mean, I at the time I didn't want to say it publicly. People would have been scared to death. They would have left.
No, I mean, I agree.
Yeah,
Just
yeah.
kind of giving that, like, every once
Yeah.
in a while, like an update.
Yeah,
that
yeah,
kind of thing.
yeah, sure.
resourceful and not wasteful.
Exactly,
Yeah.
too.
Yeah, yeah. So yeah, okay, great.
It should be a point of pride for the staff too, that
Yeah.
that collectively, a lot of help from you and the powers that be above
Yeah,
us.
yeah.
That would be a point of pride.
We'll talk more about the turnaround at a future meeting. Yeah. Thank you very much. It's my pleasure. Yeah. Thank you.